Hello, everyone. Welcome to BizTalks Unplugged, Season 2, presented by INR The Insight Room, where we open the floor for unrestricted and unscripted dialogues for curious business minds. Our today's guest is Dr. Krell, Dr. Jeremy N. Krell, and we can get to know a little more about him from his own way. So, welcome, Dr. Krell. Thank you for being on the show, and we would love to know something more about you.
Yeah, thank you so much, Srichan and your team for having me on the call. Happy to provide my background. I'm a dentist by clinical training here in the United States. I spent a little bit less than a decade practicing dentistry. I scaled up 10 practices and helped to sell them. After that, I went into the startup world where I learned more about technology and operations of companies. I went to Oscar Health Insurance and worked leading a department there around strategic provider innovations and development, running hospital system partnerships, technology integrations, and special projects. Then to Quip, where I was responsible for standing up the dental professional channel. And then to Simplify, where I came on as in a dental and marketing role, helping to broaden the reach of their existing product, 24/7 live chat, and helping expand their Paytech product, partnering it with Bank of America. All three companies I exited and then founded Revere Partners, the first VC fund focused on dental tech.
Thank you, sir. Very interesting. So, Jeremy, as we move forward, we all know that every venture, begins with a moment of realization. But building, something meaningful also requires the right person behind the, ideas. So, before you start with this, this Revere Partners, what was that moment, be it a, professional or personal experience that led you to this idea? Yes, you have mentioned about the journey, but there's always some human moment which defines a person's very actions. So can you share it with us?
Yes, happy to share. I'm sorry. Revere was really about combining dental tech and the needs of the market industry, right? In order to move the profession forward, technology is a critical component. We need to be able to be more efficient in our clinical practices. We need to run successful businesses. We need to advance healthcare outcomes of patients. And technology is a necessary component. In order for that to happen, we have to fund the technologies that need to get to market and provide value to the patients. In order to, by funding the companies, we grow the innovation or entrepreneurship ecosystem that support the growth and development of those companies. So Revere provides a very necessary role between technology innovation and the market impacts that we can have as small business professionals or large businesses in the case of DSOs, and the ultimate health outcomes of patients and experience of providers.
Interesting, sir, when you put it like that. So, Jeremy, knowing that this is the experience which gave you the point. So, at what point itself during the process that the idea shift from the conception note to a serious venture, and how has that been impacting you as an individual?
Yeah, it's a really, really good question. When we started Revere 6 years ago, we weren't sure if the market was right for a fund. So we did a lot of research, and what we found was there were a lot of types of dental startups at various different stages of development, and that from individual private investments, these companies did have an attractive average timetable and average return multiple. That shifted us from going and publishing a white paper with these results to actually building a team. After we built a team, we started diligencing new deal opportunities. After we did that, we started raising capital. And after we raised the capital, we deployed it in the most attractive investment opportunities. So we kind of shifted there from concept to reality, our starting point. And where we sit today, we raised and deployed 2 funds. We're now raising a 3rd fund. We've invested in 47 companies. We've exited 4 of them that we've publicly announced, and 7 in total. So it's been a really strong growth, scale today. My role has evolved over time. We were a small and lean team when we started, and I was, really hands-on in doing everything from deal diligence to in raising capital. That shifted to a more balanced role over time, where we built the team, and on the team, I would partly help with the deal sourcing and diligence. I would partly help with the fundraising and investor relations. I'd partly help be building and growing the firm in a more managerial capacity. Where we stand today, we're raising our 3rd fund. So probably most of my time is dedicated to helping to raise that 3rd fund, but still a balanced and well-rounded role. It's taken me to a point of personal growth. I've gone from being a clinician to being a startup operator to now being an investor. So I've learned a new skill set. It's taken my time balance to a different level because I help in various functions of the firm and manage it at a high level, a much larger firm at a bigger size. It is changed in terms of, I work partly from home, I work partly from in office, and I work partly by traveling. So there's been a lot of different changes, both personal growth and development, as well as professional growth and development as a part of my journey.
Innovation tech industry, how you value the intangible assets? Because by investing, this is one of the major aspects the investor wants to see.
Yeah, I heard most of that. So by investing in these companies, we consider ourselves a strategic minority investor. So we don't own a majority share of any of these companies, right? We typically own less than 25% of a company. So we don't have control over them, but we try to guide and lead by influence. So we will help by having an advisor or board observer or board seat with the company, somebody who can strategically help the company and keep our resources flowing from us to them. We will help the company with fundraising, with regulatory compliance. We will help the company get vendor access in the industry. We'll help them associate with scale channel partners and help them position for exit when they're ready. So we really are very strategic in working directly with the companies. We're quite founder friendly. So we really try to support the leader and their team to be successful in their own individual right, as well as a portfolio company.
So one can really say, Jeremy, that your journey has clearly shaped you, how you think about the space. And it brings us to the problem itself, because, every great venture starts with an understanding of problem deeply. So if you had to, explain the core problem your venture solves to a skeptical investor.
Yeah, Revere is a venture capital fund that invests in healthcare technology with a specific focus on dental technology. The problem we solve is that without us, there's a hindered amount of capital that flows to these dental technology companies. They're very high performing. They scale very well. They exit very well. But without the growth capital that they need, they cannot be successful and the industry cannot advance. So that's really the primary problem we solve. The secondary problem that we solve is an ecosystem challenge, right? There are a lack of other connected resources. There are some fragmented resources, but a lack of connected resources that connect these early innovations to the support infrastructure that they need to be successful. So they need to connect to the corporates, the manufacturers, distributors, insurers, DSOs. They need to connect to various other channel partnerships, regulatory resources, vendors that can help them succeed. And we provide that ecosystem layer or approach as well. So really we solve the problem of hindered capital flow to these very high growth technologies And secondly, we solve the ecosystem need that they have in order to be successful in their growth and exit plans.
Oh, that's deep, I would say. Uh, but as we move forward, there's one specific question that comes to the mind. Given the technologies that you provide and you help these companies move about, in the realm from an Indian perspective of the subcontinent, how are these companies and how are these technologies that are in development or cater to them? How do they become beneficial for the Indian investors in many ways?
Yeah, absolutely. So first of all, we invest not only in North America, but globally. We have investments in India. We have investments all over Europe, the UK, for example, the Netherlands, Switzerland. We have investments in South America and Brazil. We have investments where there's really any big or large dental market, right? Where there are challenges that face a particular population or community that need to be resolved, right? Since oral health is connected to your overall health, there are clear scientific backed clinical linkages between oral health, things like periodontal disease or dental caries, and your overall health. What I mean by that is cardiovascular health, cancer, Alzheimer's, diabetes. We have an opportunity to early diagnose these problems. We have an opportunity to intervene and stop them from escalating. We have an opportunity to treat those that have already occurred in a more profound way. So the opportunity to Indian investors is to support the growth of oral health literacy, support the growth of oral health technology that overall enable more care for the Indian market. Let me add something specific in the interim about the Indian market. Where we made an investment previously, for example, was in a company that did digital supply aggregation and procurement. What do I mean by that? Yes, India is a large dental market. There are a lot of dentists and there are a lot of patients, but the problem is that they're very fragmented, right? They
Yes.
operate independently. They do not, necessarily lean on or have access. The dentists do not necessarily have access to some of the large suppliers, and the suppliers have a difficult ability to, find and get supplies to all of the dentists. So we invested in a platform that allowed all dentists to sign up and allowed lots of different large and small manufacturers and large and small distributors to bring products into the market. It was an aggregation tool on the procurement side. So it really helps for the sourcing of the latest and greatest supplies to use in the office on patients. It allows for comparison shopping and overall price competition, which is a benefit to the practice and to the consumer. It allows ultimately for market access of supplies that come from other continents and countries that might be, very well tested, very well successful, but would otherwise have a difficult time globalizing to another market. So there is a classic example of where we might invest and how we might work within the Indian market.
That's a good thing, Jeremy. The one of the thing in the aggregator part of thing, in India, there is one of the major startup in the dentistry is the dental card, and the supply chain. We can say there is the Katana Labs from the Germany, and then there is the Globe Dental in the Delhi based startup, which is basically running smalling. Basically, what is they are doing? They are organizing the unorganized part of the dentistry in India as well. So, do you see the Indian market to be grow more efficiently if we organize that market?
Yeah, I think, looking at a number of other global markets as examples, as case examples, you can see that when there's a large fragmented market, being able to provide, an option for especially self-selection at the earliest stages into more aggregated forms are more efficient ultimately and beneficial for both providers and patients. So that can happen from many different parts of the healthcare, the oral healthcare delivery process. That can be, for example, buying up dental clinics like DSOs or dental support organizations do in the US and providing back office, non-clinical business support to those practices and funding. So one way to do this is through sort of the roll up of dental practices and providing those benefits to them. Another way to do this is through what is, looks more like a GPO or group practicing organization, basically help them gain economies of scale and some bargaining power for the supplies that they need and the cost of those supplies. That's another benefit of, sort of aggregating the market and as a market matures. Another way that you see this is when healthcare in places where healthcare is not universal, where it's not necessarily a right or government, entirely government sponsored to get this type of care. And there is a private market, it's fee for service or private dental insurance. You typically see that doctors will aggregate and gain additional negotiation power with the payers and be able to get better reimbursement rates for the providers and better rates for the patients. That applies not only to the insurers, but also their employers who may be sponsoring their healthcare. So aggregating a fragmented market is really a net benefit to the patients and to the providers, and is certainly a sign of a market that is maturing in its healthcare services.
Thanks for briefing us out on that. But one of the major core solutions of as we proceed in any form of business is in a market where many startups claim innovation, and the differentiation comes with this point to be a very vital thing, that the single most defensible advantage that any product or service of these companies to be having. Now, India is a market which is very price competitive. So we have a lot of startups coming up. Some are using the the systems of the BNPL, where there's the buy now and pay later services. There are companies who are actively engaging into providing emergency healthcare systems. They are operating in 18 to 20 major cities across country. Now, from an investor's expectation, what we get is that there has to be a clear competitive moat, such as a technology, intellectual property, a distribution advantage, or unique insight. Now, given that situation, from a financial standpoint, it comes into perspective that what are the barriers to the entry and the product line of depth, that what's create the differentiation. So, in your perspective, these companies that you represent, or your own way of process, how you see these market, if a competitor tried to replicate this tomorrow, what would they struggle with the most? And in this in the Indian segment, which is now targeting globally, where does places you in general?
Yeah, definitely a few important concepts in there, and one that is a little bit different in different continents. So first of all, in India, there is a huge benefit to the technology companies in that there's an enormous amount of technology resource development capability and very efficient supply chain there. And in fact, other global markets rely on India for some of this, whether it's software development or it's product manufacturing, right? And for a startup to have access to this from inside of its own country or continent, it makes the process a lot more efficient for them. But for those inside of that market, it's also not a competitive advantage because they all have access to it, right? So that can't be there. Right. And you have a price competitive market, as you mentioned, just the nature of how the market is in its current form. So it does put more burden and emphasis on, well, what are the barriers and how do we lower them? And what is the strategic moat, the strategic sustainable competitive advantage that would make it more difficult for another competitor to replicate? Right. Typically, we find this with companies that are solving complex problems in a sophisticated way, right? Not just using AI to be called an AI company, right? Not just solving an easy problem by, overlapping two data sets that make it a little bit more convenient for a user, right? But they take a sophisticated problem. Let's use an example. So, for example, in a dental practice, the administrative or front desk staff has to speak to a patient on the phone, right? Or through their website in order to book the patient. That conversation is unique. Each individual who works in an office is trained or has a particular style that they use. Each patient has a set of their own chief complaints or concerns, and the two parties don't necessarily know what the other party is looking for. They have to engage, And ultimately, for it to matter for the practice and the patient, they've got to be scheduled somewhere, right? That's a sophisticated problem, how to get those scheduling numbers up, those patient engagement metrics, those case acceptance metrics up, right? So building, say, a tool that would listen in on the conversations, that would track a huge number of data points and per particular user, would annotate that data set, would build an LLM that would suggest ways to optimize or be better, and then to track those results being better, right? Ultimately materializing with more scheduling. That is solving a sophisticated problem. That is solving a problem that right now some of the larger, agentic solutions and workflows don't necessarily uniquely solve, right? You may be able to ask ChatGPT or OpenAI or Claude a problem, right? You may be able to give it a data set and ask it to summarize it for you. You may be able to give it a command and ask it to design something for you. But to listen into a conversation, to pick up on what each user is saying, to be able to suggest better ways to say it or do it, to be able to track back the results that come from it, that's a sophisticated problem that would be much harder for a competitor to replicate. So we look for, the moat within solving a complex problem in a sophisticated way.
One of the core metrics that we believe is the economics of the venture itself, and how we proceed about it. A strong idea that we usually get is that it must eventually translate into a sustainable business. So could you walk us how your venture generates revenue and scales economically? Also, what are the indicators of investing? Like, for example, within the Indian landscape, if we go back as history to the earlier times, the USA and India have not shared a very very operable. Yes, we have been allies in some fronts. We have been partners, but in terms of medical sector, as early as the Super 301 sanctions placed on India on the the access of the cutting edge high tech technology, medical technologies coming to India. Right now the government is has started this Jan Aushadhi Pariyojana. So in this they are as of now there's government data which shows that there are 10,000 stores placed across the country. They provide generic drugs. Okay, so it includes around 1965 drugs and around 293 surgical items, which are roughly placed around 50 to 90% lower than the price than the branded alternatives. So that puts the Indian market very price competitive, considering the population itself has a lower per capita income. So even if the cutting edge technology is being developed by some of the partners that you may have, deploying them would be difficult. So like, could you walk us through how from the point of your venture generating revenue and scaling economically to the point how these players they are penetrating the markets where it is price competitive, because price competitiveness is not something I believe is linked only to India. There are other countries who are entering into this model as well.
Yeah. So, look, when Revere looks at investing in companies, we are looking for signs of traction, right? Clear and repeatable traction. We don't have a specific threshold or cutoff or a specific metric that we look for. It's not as if 1 million or 2 million or 3 million in ARR are necessities. It's not that 10% month over month or 15% or 20% month over month growth is the limit, right? Either a floor or a ceiling within which we invest. And in fact, each company typically has its own set of KPIs to which they track and measure, to which they set their own milestones, and they try to meet or beat those expectations. That really holistically is what we look at for investing, right? We realize each market has its own different internalities and externalities. We realize that those can change over time, right? We realize that when companies are in the growth stage, they may not be profitable yet. They may be losing money, but they may, because they're growing, but they have a pathway to profitability. What is most important to us, right, and what I tell startups is that Revere is attracted to movement. to companies that are improving over time, to companies that are setting expectations or measures, they are meeting or exceeding those expectations or measures, and they are growing over time, right? That really is where Revere starts to pay closer and closer attention and may invest. So it's really more of a general principle, right, of being attracted to momentum, right, rather than being attracted to a specific, measure or specific market position or a specific market, even, as these things can change for the company. The company may decide to operate in another global market. The company may, decide to launch a new product that have different unit economics. The company may raise money, right? There are a variety of different of elements about the company that are likely to change and pretty quickly over time. But what gives us a lot less risk in the investment is when these companies have demonstrated a clear track record of growth, right? Real measuring and real exceeding of those measures of growth, and that's really where we tune in.
Of course, I mean, really, the real validation, in any form of business model, comes when the market begins to respond. And yes, every company, has a different KPI, and they may, move their operations to another global market or any market segment in particular. But from an investor's point of view, any investor, looks for is the proof of progress. That can be evidenced through the users, the testimonials, be the partnerships, revenues, pilots, and sort of other placements. So, what are the key milestones that you believe that you have achieved so far? And what are the some of these early signals or traction that convinces you that the market is responding positively? Also, there's this other part that which are the companies that partners with you? What are some of the benchmarks that you can tell in a very normal manner that you have said that okay, this thing that they have the clear vision and we're going to work with them?
Yeah. So there are, look, we look mostly at Series A stage companies. So these are companies typically that have a defined product that is commercially available, regulatory approved, it is growing, right? We will look seed stage to Series B stage, right? We will follow the company, right? We will determine. We really like to see those management teams and founders with a strong background and results in the area that they are currently working. But the products really vary. They're software, they're fintech, they're med tech, they're specialty products. They're not limited to one specific product category. It's just too limiting. And their stages vary a little bit, but are mostly Series A stage. So we might direct a company that is earlier than this to various different support structures. So if a company needs help designing or developing its product, if a company needs help gaining early market validation, if a company needs help with earlier rounds of funding or fundraising, we might direct them to other partnered resources to help them do that. Similarly, if a company is really too late stage, they are raising really large sums of money at very, very high valuations and, looking for, a really different set of resources to get to their next phase of growth that is beyond our scope. We will similarly direct them to other industry partners, large corporations, private equity funds, and similar resources that can help them at that stage. But where our real window of interest and where we believe the strong opportunity is, right, the balance between risk and reward in terms of the profile that we're looking for, are those companies that are out in the market, that are growing. We feel they're at an inflection point, right, about to travel up that hockey stick or J-shaped curve, right? That inflection point is really where they have maxed out the resources that they have, but they have a lot of revenue opportunities lined up. So they need the funding in order to increase their technology or human capabilities in order to be able to obtain that funding. So if you envision a graph that is, their risk versus their reward, right, and a straight line with an upward to the right slope, where we kind of sit is above that line. That's where we invest, sort of midway through its length and above it. right? And what you would see there is kind of a triangle. If you drew the dotted line down to the slope itself, and to the side, to the slope itself, you would develop a triangle. That triangle is the value add that we provide, right? Not just through capital, but through our strategic services. We're able to help that company without taking on additional risk. We're able to help that company really achieve much greater results, real material results, right? And to us, that could be an increase in, value or valuation, again, without taking on additional risk. So that really is where, we like to see the companies and where they're sort of at in their product offering, their product maturity when we come in as an investor. But I think the question was around, average time profile and return multiples. So in Revere's initial research, what we found, and now, right, we've grown that research, but we found in the initial research, we developed a matrix, different types of companies, different stages of companies, and in each cell, an average time multiple timeline and multiple profile. So on average, it takes about 5.2 years to reach, it takes an average of 4.8 years to reach a 5.2x. That's what our research, really determined. Now we see about 2 to 3 companies per day of the year apply to us for funding. We have, I think, diligenced over 1,700 in the last 5 quarters. We've diligenced maybe over 3,000 lifetime. And they come to us for their first, their second, their third round. So we have, easily 5,000, 6,000, 8,000 different data points, depending on the type and stage of company. And, you internally, right, we will strive for returns in 3 to 5 years. When we set expectations externally with investors, we typically tell them 5 to 7, right? And what you'll find is if you compare this against, for example, other healthcare, venture capital, it's a bit quicker. Those are kind of more 7 to 10 years, right? Where these are, more average, sitting closer to 5 years. So that's really kind of the return profile, especially if you average the different types and stages of companies together.
One of the key questions that we usually get is that the capital, when deployed intelligently, does more than finance growth. It basically kind of fundamentally shapes the trajectory of the innovation of most of the entrepreneurs. So from your perspective as an investor and an operator, how should capital be strategically deployed in a sector like the dental technology, where the clinical innovation and the regulatory realities and the market adoption all intersect? Considering that we have a a new current geopolitical situation, and investors want to know, like, how will they get the return, as it takes 4.8 years in general.
Yeah. So the way venture capital is structured is that you essentially will invest in the fund. The fund invests in the portfolio company. It works with the portfolio company to grow its value, and then it helps sell it to a buyer. And then the buyer gives the money back to the company gives the money back to the fund gives the money back to the investor, right? Really, to be clear, this is largely considered an illiquid form of investment, meaning the returns, the capital gains from this investment really come back when the companies exit, when somebody acquires the portfolio companies, and typically not sooner. So what's really important is investing, a couple of concepts. Investing in a fund versus investing directly is a lot less risky. And when you invest in a fund, you really need to look at what is their core philosophy, your strength of belief in the operator of that fund, because they're the ones placing and growing your capital, right? And then lastly, what options do they have, right? And how do they, essentially structure that to help make sure that you do get your returns, especially in, worst case scenarios, right? So those are really kind of the important concepts. Let me address each one of them briefly. So first of all, investing in a fund is less risky than investing individually. Yeah, because, for example, we see 2 to 3 companies apply per day. We see thousands of companies, right? So first and foremost, we can comparison shop them better than an individual can. Secondly, we do diligence. We run a 26-point diligence process. We ultimately end up writing an 80-page diligence report. It ultimately ends up getting voted on by nearly 24 people in an investment committee who are all experts in the field, right? Thirdly, they get better terms, right? A venture capitalist, because they can help the company grow, is going to get the best terms in the investment round, right? Better than any individual. And next, they're actually able to help the company. While you might be able to give it some advice or refer it to your friend, a venture capital company can typically help it with regulatory, with channel partners, with exiting, right? And then lastly, it helps manage your portfolio all in one place. The venture capital company is going to go invest in 20, 30 or so companies in its portfolio. Doing that individually would mean a lot of tax or accountant fees. It would mean a lot of legal fees, right? It'd be a very big effort to manage that. Whereas most venture capital funds like us, we provide all of this included in the investment and the fees. And we also host it all on a central digital portal, right? Then when you break it down further, what is the philosophy of the firm? How do you believe in the operator, and how do they structure this? So, right, generally speaking, right, Revere, and you either align with the philosophy or you don't. We're supporting dental technology companies. We're trying to advance this industry through science and technology. We're trying to make care more affordable and accessible. If that message resonates with you and the impact you want to have with your money, then this is an investment, worth considering. If it's not, then this may not be the right investment for you. Also, we can't give financial advice, right? Venture capital largely would be considered one part of a well-balanced portfolio, but it's usually not the only part of a portfolio. You might be investing in stocks and bonds or mutual funds. You might be investing in real estate or other alternatives, power and energy, food or longevity, right? Other sectors. So you have to consider it as a part of the overall pie. In terms of how we structure it, for example, our carried interest, the fees that we as general partners make are, in our case, a European waterfall method, meaning you, the investor, has to get back all your capital first, right, before the GPs start assessing carried interest or make anything on that capital gain, right? So you have to look out for how they have structured it, right? Do the general partners really prioritize getting the investors paid back? That's a key element. What options do we have, right, is another component of this I've mentioned. So we sign very important side letters with every company that we make an investment in. We have a position on the board. We have most favored nations. We have pro rata investment rights. We have other information rights, right? We often have anti-dilution. We have liquidation preferences. We have a whole set of preferential terms that help protect us, inclusive of selling secondaries or participating in secondary rounds. So if there is an opportunity or a need to get out of the investment sooner, again, venture capitalists typically like to leave their money in and grow the value maximally and then sell, be exiting. But if there is a need to get out, right, did that fund manager protect that right for the fund, right? So these are all things that Revere does, right, to help ensure that this is, an optimally successful investment for ourselves as well as for our LPs. And these are things you need to look out for when you invest in a category like this.
That makes a lot of sense. And, I can almost relate to it that in early, stage innovation sectors, capital efficiency often, determines long-term success. And somewhere this is the insight into the execution, the discipline, and the venture scalability, and how the company is able to convert that capital into the durable growth. One interesting question lies here that with the AI, entering into the market segment of not just technologies but also the optimization, have you invested in the the robotics industry as it is advancing into the dental realm? And what's your future outlook for that?
Yeah. So, look, we look at a lot of future of dental, care and where the industry is going in terms of how we invest. Obviously, AI being an efficient tool to companies is one part of it. We look at robotics, right, that can help provide greater affordability and accessibility to care. There's not enough hands to treat the number of patients and the number of procedures that they need, right? So we lean on things like robotics. to be a big part of that. We look at tools that can be more active in a diagnostic or preventative capacity, right? How do we stop all this periodontal disease or all these dental cavities from forming? How do we detect them early when just minimally invasive care is needed? We look at the interoperability of data, right? In order for practices as businesses to find these problems, and in order for healthcare professionals to make sense of what is needed for the patient, there is a lot of emphasis put on the data integrity that is in front of them. We look at oral and systemic health integration, right? How does the oral health category overall connect better with the healthcare category, right? Because obviously your oral health, as we covered, really interacts with your overall health. So we look at quite a few of the categories that are developing, not just that are developed, right? We may come into an investment that is, really seeing emphasis now in the market, and that could be a very, very, very productive, accretive investment. But we also look at investments where we know the market is, a few months or a couple of years even out from full maturity, and we can see an even bigger growth curve there and an even more lucrative outcome. So we look at both kind of where the market is now, where we think it's going to be, and therefore determine what segments we want to play in. But it is a very clear segmentation or mapping exercise, right? Especially in fragmented markets, inclusive of dental technology, to figure out what those segments and subsegments are, who the players are within them, and who are the leaders within those categories.
That's very true, man. And every emerging sector also carries structural risks, be that regulatory shifts, the reimbursement models, or even the technological disruptions. The sense that is so much prevalent with the AI modifications that are happening. So from your view, what are some of the potential headwinds should innovators and investors be most mindful of the incoming decade? Because we are going to see some of the rapid changes which is going to happen in terms of technological sector. So from your point of view, what is that? And what is your future outlook towards this industry?
Yeah, look, I think it's a very robust, in terms of future outlook, I think it's a very robust industry. I think, at the end of the day, it's insulated. People need a dentist, and whether or not they like it, they interact with it, right? There are people who go, every few months or a couple times a year to make sure that they are cleaned and x-rayed and, diagnosed appropriately. And then there's people who try to never go and, run into infection or into pain. And in that case, they have to go and essentially be bailed out of a health crisis, right? And there's a lot of people in the middle that are, not quite at clinical care, but through treatment can be, more easily returned to clinical care. So one thing that's really good about investing in the technology is that the consumption side is always there. Patients continue to have a need for oral health care. Providers continue to provide it. There's quite a bit of margin in doing so. And so there's really a great place for dentistry, going forward, even in the presence of, multiple sigma black swan type events, pandemics, market crashes. It's been proven over and over again that the dental industry and its unit economics return to par, if not above par, within a calendar year. So it's a very, very strong sign for the defensibility and robustness, and ongoing longevity of the dental sector. Some of the headwinds, there's quite a few, both headwinds and tailwinds, right? I think this private equity and its ability to fund these practices or DSOs, and whether that puts the DSOs in a growth mode, acquiring or building new practices, versus a same store growth mode, optimizing their current performance. Both of those are different factors, but both have technology as a factor of them. So that's a very, very big one. How the oral healthcare industry comes closer to medical care, and that varies a little bit culture to culture and continent to continent, but generally speaking, does it become, and we believe it will become, a part of primary care, right? Dental will not exist as sort of a separate specialty, but be part of your primary health care. People tend to go to the dentist more frequently than they go to the healthcare professional, like the primary care physician. So we believe that that's a big factor, and everything that stands in the way or helps push that forward is really a big part of the future of dentistry. So we think that's a big one. Yeah, the regulatory environments, they shift, and that's going to be, important to watch. At this current moment, it tends to be a little bit easier to get the FDA approval, for example, compared to MDR in Europe. But on the other hand, it's much, much, much more cost effective to do your clinical trial in South America or in Europe or in another continent like India. And so, that changes year to year. Sometimes that's not the case. And so that's a very, very important kind of trend line to watch. So these are these are all, I think, key aspects of the future of dentistry.
That was indeed very insightful, Jeremy. And before we conclude, it's something that we move from every individual that we ask that I'd like to ask one final reflective question. Now, this question explores not just the guests' thinking, but more of their own view of how they are and how they view the world themselves. So, if someone is watching this today, and perhaps, and I know people are watching it, so what is considering in building a venture in your industry, and what is the mindset or principle would you like advise them to carry into that journey? And what are
Yeah.
some of the investors' expectations? Like, what does an investor look forward? What is he investing in really? And what is he doing? Because it's not just about returns. Because any business which makes only money, it's not a business. It's a very poor formula. So somewhere we believe that okay, apart from the returns, we are making something as a contribution to the society in general. So what is that mindset from your side?
Yeah, no, I agree wholeheartedly. It's true of both the fund or fund manager as well as the portfolio company or its CEO or founder. Really, what you're looking for is impact, right? At the end of the day, I myself individually, as an individual, Jeremy Krell, I could be a dentist and I could practice in a practice and I could treat 1,500, 2,000 patients a year and several thousand over the course of, say, a 30-year career. And I could individually impact their smiles and their physical health and their mental health by doing so, right? That's one, and there's nothing wrong with any of that. That's a very fulfilling and satisfactory and valued profession, right? I saw a different path, right? I followed my passion for technology and operations. I followed my passion for investing. But really underlying that and underlying the assets we invest in is the impact we can have, right? Compared to being that dentist, in one dental practice, treating one population of patients, compared to being that leader at a startup, which might treat a lot of people. When I was at Oscar Health Insurance, we scaled from hundreds of thousands of patients all the way up. At Quip, we sold, ultimately 20 million toothbrushes into 120 countries. Right? You can have a very big impact with some very big numbers, right? But if I'm an investor and I've invested in 47 different companies, my impact is force multiplied, right? Across the entire portfolio. I can help thousands upon thousands of dental providers, professionals. I can also help millions of patients by doing that, right? I think there's also a component of abundance mindset. Right. A lot of people jump into competition and they don't want to share information and they assume the worst of a counterparty. And, what I've learned over the course of time is that a rising tide floats all boats. There are many ways where your biggest rivals and biggest competitors can actually be some of your biggest advocates and some of the biggest resources that help you. For example, having a competitor who's also raising or has successfully raised capital or reached a milestone further validates the market segment that you're in. And very few of them have just one successful player in them, right? So it's really helpful to look at it from a broader perspective of really abundance, right? What resources can help me? Who can I help by sharing and receiving information, by connecting people, right? By being a connector. I think that's really important. And then lastly, there's this category of partnership, right? What exactly does that mean? It's relatively easy to sign a piece of paper that says we're partners, right? But for what, right? What value are we really providing to each other? Are we both really focused on doing that? Do we continue to contribute? There are only so many. There are a lot of partnership agreements that get signed, but there's really only a few partnerships that are really valuable to each other, right? And so choosing and being a good partner, right, I think is a way to help yourself, to help others, and to help society. So I think what you really have there is impact. You have abundance mindset, and you have partnership.
Thank you so much, Jeremy, for speaking with us. And we got to know a little bit more about you and the work you're doing. And it was such a pleasure to have you with us. And I'm sure with this brief insight, we'll be connecting a little later.
Appreciate being here. Thank you for having me. You can always reach me at jeremy@reverepartnersvc.com, or you can visit our website, reverepartnersvc.com. I really appreciated talking to both of you, and hope this is a net benefit to your audience.
Thank you so much, sir. Have a good day.
Thanks, guys.